and welcome to our finance mini-series. I'm Dr. Robert Clark, and today's video is on fundamental analysis. When it comes to investing in the stock market, there are two main types of analysis that investors use, being technical analysis and fundamental analysis. Technical analysis focuses on studying charts and market trends to predict future price movements, while fundamental analysis looks at a company's financial and economic fundamentals to determine its intrinsic value. In this video, we'll be focusing on the basics of fundamental analysis and how you can use it to evaluate a company's worth. One of the most influential figures in the world of fundamental analysis is Benjamin Graham, who is often considered the father of value investing. He's released books such as Security Analysis and The Intelligent Investor. I've actually got a copy of Securities Analysis on my bookshelf at home, though I've got to admit it's really big and it's quite dry. So there's not too much of that book that I've actually read myself personally. Anyway, Graham's approach to investing emphasized the importance of analyzing a company's financial statements, such as its balance sheet, its income statement, and its cash flow statement. By carefully examining these documents, investors can gain insight into a company's profitability, its liquidity, and its financial health. One key concept that Graham introduced was the idea of a margin of safety. This refers to the difference between a company's intrinsic value and its market price. In other words, if a company is trading at a price significantly lower than its true worth, there is a margin of safety that protects investors from potential losses. A representation of intrinsic value might be arrived at via a DCF analysis, which I touched upon in the time value of money. In terms of Graham's margin of safety, you'll see a representation of this on most sell-side analyst calls. For example, if a stock is trading near the analyst price target, they'll call it a hold. If it's, say, 15% below their price target, they'll rate that stock as a buy or as accumulate. So how can you go about analyzing a company's financial statements? Let's take a closer look at some of the key metrics you should pay attention to. First, you'll want to examine the company's revenue growth over time. A company that is consistently growing its revenue is generally a good sign, as it suggests that demand for its product or service is increasing. Next, you'll want to look at the company's profitability, which can be measured in a number of ways. One commonly used metric is the return on equity, ROE, which measures a company's net income as a percentage of its shareholders' equity. A high ROE indicates that the company is generating strong returns on its investments. I'll touch on later why maintaining a myopic focus on certain metrics can cause you to miss opportunities though. You'll also want to examine the company's debt levels, as too much debt can be a red flag. One way to do this is to look at the debt to equity ratio, which measures the company's total liabilities as a percentage of its shareholders' equity. A high debt to equity ratio can indicate that the company is taking on too much risk, too much debt, and may be at risk of defaulting. Typically, one would assess similar companies in the same industry to figure out if specific metrics are good, bad, or average. You'll also want to look at the company's valuation metrics, such as its price to earnings ratio. This metric compares the company's current stock price to its earnings per share. And it can give you a sense of whether the company is overvalued or undervalued. But as you'll come to see in finance, things are rarely so simple. A company with a low PE might be cheap, or it might look cheaper than a company with a high PE. But if that company with the high PE comes with exceptional revenue growth, The high PE may actually be the cheaper company on a forward-looking basis. Of course, these are just a few of the many metrics that one can use to analyze a company's financial health. And I need to stress that this is just part of the puzzle. For example, if you maintained a myopic focus solely on PE or return on equity, you would most likely have missed opportunities in the tech industry where the profits might yet not exist. Now, this is all your FANG stocks, your Facebooks, Amazons, Netflix. Or you may have missed opportunities with newer instruments such as Bitcoin. In these circumstances, there are other techniques which I'll touch upon in other videos, such as the network effect. Basically, the key is to be thorough in your analysis and to use multiple metrics to get a well-rounded picture of the company. And one must not forget that companies do not exist in a vacuum. Interest rates matter. The economic outlook matters. Geopolitics matters. Elections matters. Even the weather matters. So you should remember that this is just part of the puzzle and that the market is not a monolith. Industry, sector, and currency also matters. So in summing up this short video, fundamental analysis is a crucial tool for investors who want to make informed decisions about which companies to invest in. By analyzing a company's financial statements and metrics, individuals can gain insight and understanding into the company's position and its profitability, its liquidity, and the general health of the company. And as a result, you can make smarter investment decisions. As with everything in finance and investing, there are always other considerations, which I will touch upon in subsequent videos. I hope you've enjoyed today's introduction to fundamental analysis, and please don't forget to subscribe. Thank you.